Now, emerging markets struggling as the SMCI Emerging Market Index is on track for its steepest fall in 7 weeks off of all of this news. So to break it down, we have Patrick Zweifel. He's the chief economist at Pictet Asset Management. Thank you so much for being here with us, Patrick. Now, I'm curious, over half of the world's global leaders are up for re-election this year. So this is only an issue that's going to continue to be on top of investors' minds. How much volatility should folks be pricing in because of these elections?
Yes, so first, thank you for having me. And you're absolutely right at pointing those two major elections in the M space. And so our global view would generally be that, we focus less on the immediate implications of the elections and more on the fundamentals and what could be the impact of those elections on precisely those fundamentals that, in our view, remain strong in both countries that you mentioned. If we just take, the Indian example, for example, we do think that, the immediate reaction is overdone because, there are various conditions that people and foreign investors tend to underestimate in India. One of the first elements is that main game-changing policies that had been implemented in India in the early 90s were done under government coalition. The second one is that India is a very federal structure and with most decisions taken at the state level. And the third one being that Modi has been personally committed to fiscal consolidation, which is key in India. So we don't think that policy's priorities have changed much, and we remain very structurally positive on the Indian markets. To talk about India.
It's excellent insight, Patrick. And when we think about the global elections, is there any one election that jumps out where there could be a massive pivot or continuation in some cases of deglobalization that could then provide even more inflationary pressure?
Right. On that aspect, I do think that regarding deglobalization itself, I think it's essentially happening on goods, as we know. So with the risk of having more import tariffs and trade wars globally. So this is happening. But at the same time, I think we do have a much bigger force at work, which is the globalization of services that's taken place, with more and more, service jobs being telemigrated and then taking place in the F sphere. So if you just compare, so the risk of having higher inflation due to a higher price of goods versus the decline in the price of services that start to be internationally traded, our view would be that you could even think about potential disinflation globally thanks to that increased competition on the service side.
Well, I guess I still am stuck on how investors should price in the volatility, Patrick. And I know you're looking at it from an economist perspective, but give me a sense of what degree of economic volatility we could be seeing, particularly in the U.S. due to these elections. Obviously, we're heading for our own election here, but sticking with the global perspective here for a second, to what extent could the global re-elections that we are seeing across the world start to impact the U.S. economy at all, and what would that look like?
Right. We can take one example again in the M space. So we had South Africa, for example, which was also a surprise in terms of the result of the election. And again, what it creates, because we didn't have a clear majority there, and we will have a few weeks of uncertainty before having a coalition, and therefore, of course, that leads to more market volatility, rand depreciation, etc., and putting the rand under pressure. So for the US, again, the volatility will come from its own election, as we all know, and with high uncertainties there, and with potential very disruptive policies that could be implemented by having Trump for a second term, and this is again the main risk for global volatility. But I do think that it's extremely likely to come more from the U.S. than from the rest of the world.
It's interesting here as we've got a fresh decision out from the Bank of Canada that's reduced their policy rate by 25 basis points. I mean, these are some of the broader things that you discuss and that you write about in your column as well. What did you just get your reaction to this decision out of Canada?
Well, I'm not covering Canada myself, but my colleague was expecting that move. I think we do think, globally all central banks are facing pretty much the same kind of business cycle. So what we do have on one side is inflation that remains rather sticky due to price of services that are rather sticky, and on the other side we do have an economy which, like in the US, remain resilient, but with strong demand on services that we would generally expect to soften. So reducing that pressure on service inflation, and therefore what central banks should actually look at is how tight they are in real terms, and maintaining that restrictiveness sufficiently long to make sure that indeed we do have inflation going back to target. So, but meaning when I say maintaining restrictiveness, it's obviously in real terms. So that still allows central banks to actually cut their nominal rates in line with declining inflation. And I think this is what we're going to observe in most major economies this year. So with the Fed likely to cut rates in the second half, we do expect them to cut twice, for the ECB 3 times, and despite inflation only going gradually down. But I think what matters is real rate there.
Patrick Zweifel, who is the chief economist at Pictet Asset Management. Patrick, thanks so much for taking the time here and giving us some of your insight.
Yeah, thank you very much for having me.